Welcome back to Investing Talk Podcast.
Today we're looking at Navitas Semiconductor. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. To understand Navitas, we really have to start with the sheer, almost explosive momentum the stock has shown.
Yeah, explosive is the word. It's not just steady growth, is it? It's like a rocket.
Exactly. It's more like a parabolic ascent. It's the kind of thing that, leaves traditional financial models just scratching their head.
Absolutely. I was looking at the numbers. They're frankly staggering. Shares are up, 317% year to date?
That's right.
And if you zoom out a bit, over the past year, it's something like 482%. Most people see that and just think, wow, this company must be absolutely crushing it financially.
Right, that's the immediate assumption.
So what's really under the hood here? What's the core engine driving this kind of runaway success, or at least speculative success?
Well, it really boils down almost entirely to their technology, their next-gen tech, and smart market positioning. Navitas specializes in power semiconductors, but they're not using plain old silicon. They use materials like gallium nitride GaN and silicon carbide, SiSu.
Okay, let's pause there for a sec, because someone listening might hear GaN and SiC and just think, okay, more tech jargon.
Well,
why are these actually different? What do they do that's so revolutionary for power management?
that's really the key thing to grasp. These materials, they fundamentally change how power is delivered and managed. Think about it like this. GaN and SiC let power devices switch maybe up to 20 times faster than old silicon. And critically, they can shrink the physical size of components. We're talking like 4 times smaller while keeping efficiency high.
Right, so smaller, faster, more efficient. That sounds like the holy grail for anything that needs a lot of power in a small space.
Precisely. They are essential components, kind of like the picks and shovels, for these huge growth sectors where space and efficiency are just paramount. Think AI data centers jamming massive power needs into tiny server racks. Think electric vehicles needing fast charging and efficient power use. Advanced consumer electronics, too.
Okay, that makes sense. And there's a big validation point recently, wasn't there? Something that really lit a fire under the stock.
Yes. That's where it gets really interesting, as you say. Back in October, Navitas announced a major partnership with NVIDIA.
NVIDIA. Wow, okay. That's a name everyone recognizes.
Exactly. And that announcement was the catalyst. The shares just soared over 25% on that news alone. Because, having NVIDIA partner with you is basically a giant stamp of approval. It validates Navitas as a key supplier, like a mission-critical piece in the whole AI data center power management puzzle. That's really what's been driving this recent momentum.
It's definitely easy to get caught up in that excitement, that NVIDIA halo effect. But, okay, we have to look at the other side too, the financial reality. If the tech is that critical and they've got NVIDIA's backing, why aren't the fundamentals, the actual dollars and cents, lining up with this half a millennium worth of growth valuation?
And that's the core tension, isn't it? You absolutely have to understand this part. The growth right now, it's momentum-driven, it's hype-driven. It's not yet supported by consistent revenue performance. If we look at their Q2 2025 results reported back in August, the operational performance was, starkly challenging.
Challenging feels like a polite way to put it. The numbers I saw show revenue actually declined 29% year over year in Q2. That's not growth.
No, it isn't.
And their net losses per share more than doubled, from 12 cents loss to 25 cents loss per share. That looks like they're spending a ton of money probably to get these deals and scale up, but the sales just aren't flowing in yet at that level.
That's exactly right. They're deep in that costly scale-up phase, especially scaling up silicon carbide, SiC production. That's incredibly capital-intensive. You've got huge R&D costs, securing the intellectual property, building out these complex manufacturing capabilities, all to meet the anticipated future demand from giants like NVIDIA.
So let me see if I get this straight. Navitas is currently priced like it's already a dominant, profitable giant, but it's operating more like a startup that's still burning through cash to build a business.
That's a very good way to put it. Navitas is not profitable yet. Their net loss in 2024 was still around negative $84.6 million. Now, to be fair, they are showing some progress in narrowing those losses, improving operational efficiency, but they're definitely not in the black. And for a company carrying a market cap that assumes massive future growth, this lack of current profitability, that's the single biggest fundamental risk you have to weigh.
And that lack of profit, it feeds directly into the stock's crazy volatility, doesn't it? We're talking a beta of 3.02.
Yeah.
For anyone unfamiliar, that means it swings roughly 3 times harder than the overall market. That just screams high risk.
It absolutely does, but what's really fascinating here, I think, is the huge disconnect you see within the analyst community. Look
Yeah,
at the data. The average 12-month price target from fundamental analysts, it's sitting way down around $5.50.
550. But the stock's trading around $14.24 right now.
Exactly. That's not a gap, that's a chasm.
Wow. So the people paid to scrutinize the financials, the balance sheets, the cash flow, they're essentially saying the stock is wildly overvalued, maybe by like 60% or more.
Massive signal, yeah. It tells you there are kind of two different markets operating here at the same time. You've got the, let's call it the mathematical market, driven by earnings multiples and cash flow analysis, saying the stock should be much, much lower. And then you have the speculative market, completely fired up by the future promise of GAN and 6i, the NVIDIA news, and just pure momentum trading.
Right. So when you invest now, you're essentially placing a bet on which of those narratives wins out in the near term.
Precisely. Are the analysts just slow catching up, maybe not fully pricing in the NVIDIA catalyst? Or are they correctly flagging a potential bubble based purely on those lagging financials? That's the million-dollar question, isn't it?
Okay, let's switch gears slightly to the technicals. Because despite all those financial warning signs, you can't deny the technical breakout. The chart looks strong. The stock's trading near its 2022 highs, right?
Sure.
And it just had that run, like 5 straight days of gains recently, fueled purely by that optimism about future growth.
Oh, the technical setup shows extreme strength, no doubt. You look at the key moving averages, the 50-day, 100-day, 200-day, they're all firmly signaling buy. That indicates a strong, sustained uptrend. But, and this is a big but, that high volatility we mentioned, 36.66% over just 30 days, that means a sharp reversal isn't just possible. On any whiff of bad news, it's actually statistically quite likely.
And that volatility risk is magnified by some specific company risks we should probably touch on. We've hit the lack of profitability and the execution risk. Can they actually turn these big partnerships into real revenue streams? But let's quickly explain another one that's critical for existing shareholders. Dilution risk. What is that?
Right, this is vital. Dilution risk basically refers to the company potentially selling new shares of stock to raise cash. Since Navitas isn't profitable and is burning cash to fund all that R&D and scale-up we talked about, they periodically need more capital. Selling more stock is one way to get it.
Okay, so they issue new shares.
And when they do that, the total number of shares outstanding goes up, which means your existing shares represent a slightly smaller piece of the overall company pie.
Got it. So even if the whole company becomes more valuable over time, if they keep issuing lots of new shares, the value of your individual slice might not grow as fast or could even go down. That sounds like a real headache for long-term investors in these kinds of growth stocks.
It's a significant factor, yes, precisely. Okay, so now let's look ahead. Because investing is always about anticipating what's next, right? The single most critical near-term event, the one that could really set the direction for the stock, is their upcoming Q3 2025 earnings release.
Okay, and that's coming up soon, November 3rd. When that report drops, what specifically should people be watching for, beyond just the headline revenue number?
You need to look for signs that this momentum, this potential, is starting to translate into tangible guidance for the future. Did that NVIDIA partnership start moving the needle on revenue even a little bit in Q3? More importantly, what does management say about 2026? Are they guiding aggressively? Wall Street estimates tied to this report are pretty wide. They range from about $13.37 on the low end, that's if guidance disappoints, up to maybe $16.95 on the high end, if they give real clarity on the path to profitability and how quickly these partnerships will scale.
Okay, so earnings are huge. But beyond that specific report, there are also some structural market things happening in the next couple of months that could really push the stock around, right? Technical factors?
Correct. You've got the ETF rebalancing window coming up in mid-November. Given Navitas' monster performance this year, index funds and ETFs that hold it will be forced to adjust their positions based on its new higher weighting. This is purely technical buying or selling, driven by fund mechanics, not fundamentals, but it can create huge volume and price swings.
Right, and then in December.
Then you get institutional year-end positioning. Big funds might be locking in their huge gains on Navitas, or maybe trying to add more to boost their end-of-year performance numbers before they close their books.
Yeah.
Put those two together, ETF rebalancing and year-end positioning, and it basically guarantees volatility is going to remain extremely high right through the end of the year.
And looking just a bit further out into the new year, CES 2026 in January. That's always a big show for tech components, isn't it?
Absolutely. It's the traditional place to make a splash. You'd fully expect Navitas to use CES to show off new products, maybe demo some applications, and crucially, potentially announce more strategic partnerships, especially trying to land something big in the automotive space, perhaps, to keep that momentum rolling into Q1.
Okay. And finally, we sort of have to address the speculative buzz, the rumors, because let's be honest, that's probably driving the $14 price just as much, if not more, than the confirmed deals right now.
Oh, the Mar chatter is incredibly loud on this one. The biggest rumor revolves around an expanded NVIDIA collaboration. The idea is Navitas might become a preferred supplier for NVIDIA's next-gen AI accelerators. That would mean huge volume, potentially locking in IP advantages. Huge. Separately, there's a lot of anticipation about a major design win with a top-tier automotive manufacturer for their EV platform. Landing a big auto name would really solidify their position in that massive growth market.
And then there's the ultimate speculative rumor, the one that would be an absolute game changer if true, the whispers about talks with Apple for GaN charger tech in future iPhones and MacBooks.
Right. That's the golden goose of rumors. Look, it's unconfirmed speculation at this point. But if something like that were to materialize, it would instantly solve Navitas' revenue scale problem overnight. It would be the ultimate validation on the biggest consumer stage possible.
Okay, so pulling this all together, we've got incredible tech, huge potential markets like AI and EVs, a massive NVIDIA partnership, but also no profits yet, scary financials, extreme volatility, and a lot of speculative buzz. What does this all mean for you, the investor, trying to decide what to do now, long-term versus short-term?
Well, the company is clearly at a critical inflection point, no question. Its technology is leading edge, absolutely. They seem to have a strong tech moat in markets that are definitely accelerating AI, EVs, you name it. However, that leadership, that potential, it has to convert rapidly into sustained accelerating revenue growth to even begin justifying the current stock price. So for certain types of investors, maybe highly aggressive traders looking to capitalize on near-term momentum and these upcoming catalysts, the earnings, potential CES news, you could argue it's attractive. Maybe an 8 out of 10 for that specific high-risk trading approach over the next, say, 3 months.
Okay, bullish for traders. But what about for someone thinking longer term, someone who wants to buy and hold?
For longer-term investors, it's a much tougher calculation. You must weigh that high potential growth against the very real current lack of profitability and the extreme volatility. It's a classic high-risk, high-reward situation where the market is clearly pricing in success years down the road, far ahead of today's actual earnings power. The fundamental performance just hasn't caught up to the technological promise yet.
Which really raises an important question for all of us watching these markets, doesn't it? In a momentum-driven market, fueled by the massive promise of AI and next-gen tech, how long can that exciting technology leadership keep outrunning, frankly lagging, financial performance before the market finally turns around and demands to see the actual bottom line results? Something for you to definitely ponder.